All right, and we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Welcome you here for one of our Wednesday live streams. This time it is with David Hay, returning with his monthly macro and markets outlook. David, how you doing?
Good, Adam. How about yourself?
Doing
the California
great.
Tax Police.
And you know, David, pardon me?
California tax police are not hot on your trail now that you're back in the state briefly?
Oh, hopefully not. Hopefully not. Yeah, David, folks, David's referring obviously to my my move to Nevada. Yeah, hopefully I've got nothing to do with California tax police from here or ever, David, and hopefully they're not listening. But if you are, folks, nothing to see. All right, well, look, lots to talk about this month. A lot going on. David, as usual, has prepared an excellent slide deck for us, which I'll get to in just a second. And just as a heads up, folks, as we did last time, we will be doing an outlook, David's outlook for the current landscape in the month ahead. And then we'll end, and then David and I will record sort of a retroactive of the past couple of weeks of some of the most meaningful interviews that have happened on Thoughtful Money that have caught each of our attentions. And that second video will be available to members of this YouTube channel and premium subscribers to the Thoughtful Money Substack. So just a reminder again, as we did last time, we're going to do the part one first, which will be available to everybody, and then we'll hop off and we'll record the part two, which will be available just to those audiences. But David, a lot going on here, and look, maybe we can get pretty much straight to your slides, but there was a key slide in there that I made the theme for this discussion, which is that it seems that we are at a tipping point here where U.S. Treasuries are no longer the reserve asset of choice. And that potentially has a lot of ramifications, and clearly it's got one for gold. So I'm sure we'll get to that quickly. But anything you want to say before I bring the slide deck up?
Well, just to reinforce what you said, I did a webinar yesterday with my great friend Grant Williams, and that was one of the hot topics that he and we both agreed with. So there wasn't any, was not an opinion exchange, but the idea that the dollar is very much the world's reserve currency. So that hasn't changed. But what has changed is U.S. Treasuries are no longer the reserve asset of choice among central banks, global central banks. And that's profoundly important. And I think that's the main reason that we're seeing gold knocking on the door of 4,000.
Okay, and I only had a moment to slip through your slides, so don't know if this chart's in there, but I have seen a slide recently that shows percent of assets held by central banks, and we have just crossed where gold as a percentage of central bank balance sheets has just poked above treasuries, which had been in decline. So to your point, yeah, dollar is still the world reserve currency, but in terms of the dominant asset on central bank balance sheets, it seems gold has now just nudged out treasury, which isn't the first time in history that's happened, but it's the first time in a long time. All right, well, why don't we, without further ado, get to your slides here, David. So you. I'll drive for you, so you just tell me when you want me to advance.
I like this. It's kind of like driving Miss Daisy.
Driving Mr. Hay, Dr. Hay. All right, well, why don't we start here with your uber bullish zeitgeist quote?
Sure. Yeah. Are you moving it? Because it's not moving on my end, but I can stay up with you.
All right.
Okay,
yeah,
so
we are here on slide 2.
All right, and this is a quote from Andrew Tyler at J.P. Morgan, which I just thought was a great summation of this attitude that the stocks can really only go up unless there's an asteroid that hits the Earth. And I think when you get to that kind of a scenario, you know that you're just in, absolutely super rarefied air when it comes to a bull market, almost without precedent. In fact, I'm going to make the case with some of these that it is without precedent, that it really has taken out the biggest equity bubble the U.S. market's ever seen, which wasn't 1929, it was the late 90s tech bubble. So the basic point here is that, and that doesn't mean it's going to end. I mean, that's, I guess, Adam, just as this is a completely off the cuff line, but one that I think I've conveyed to you before. And I think is so important when you do these kinds of events where there's a tendency for us to be who are on screen. And, we've been doing this for a long time, my case, 46 years in the financial industry, but I haven't ever seen a set of circumstances like this. So my outlook, my anticipations, if you will, not forecasts, but anticipations are very cloudy and should be taken with not just a pinch of salt, but a whole shaker of salt.
Okay, and let me just quickly ask you about that, David. So this may be the greatest market distortion of your career, is sort of what I hear you saying.
It is.
How concerned are you about that? Like when it comes to a losing sleep over the markets perspective, are you not getting any sleep given these concerns, or is this, hey, yeah, it's just more distorted than I've seen in my career, but for reasons X, Y, or Z, I'm not afraid of a massive calamity ensuing as a result?
I'm not afraid from a financial standpoint, partially because I'm personally very heavily hedged, and for the firm that I co-founded, and I'm still the second largest shareholder in Evergreen, they're very appropriately positioned. And one of the points that I've tried to make, I know I've discussed this with you in prior podcasts, is I've been selectively bullish and selectively bearish. And there were a lot of areas, as you know, I write a Making Hay Monday that goes out every Monday, except on if it's Memorial Day or Labor Day, it goes out on a Tuesday. But there's always buy ideas every single week. Some are bonds, but usually they're equities. There's been a lot of places to be, even if you've been kind of a bubble denier, as I have been. And we're going to talk about the gold stocks later, but it was just in the spring that you couldn't get people to touch those with a barge pole. Mm-hmm. And obviously they've had an amazing resurgence. I don't want to get too far ahead of this, but I'm not concerned from that standpoint. What I'm concerned about is just, this idea we're in a fourth turning and that it could turn violent within the United States. In fact, I think it already is. You just look at these announcements of the National Guard being sent into blue cities almost exclusively, but it just seems like this political divide that has been so acute and very disrespectful. It's so different than back in the 40s when Reagan and Tip O'Neill were able to work together. So what I worry is that this societal division is now on the precipice of becoming violent, even more violent than it has.
Yeah, I would say even more violent.
You've been you've been so articulate describing the K-shaped recovery and maybe even now an I recovery, and so it's getting worse. This wealth division, the prosperity for a few, just getting by hand to mouth for many. It's just not healthy, and that's what really worries me.
Okay, and just to let folks know, for those of you who know about the fourth turning and that whole framework, trust me, I have been reaching out to Neil Howe, one of the co-developers of that theory, the sole living co-developer of that theory, to get him back on the program to really give us an update on where things are in the fourth turning. As you can imagine, Neil's schedule is just, on fire right now because everything he's been talking about, it really seems to be now unfolding in real time around us. I did just lock Neil in for an interview. It's going to be, I think, the first week in January. So I know we all wish it were sooner, but I want to let you know that indeed it is coming. And that was as soon as we could find time on Neil's schedule for it. All right, David, look, I'll let you just run on the slides here, but yeah, I don't know if that makes me feel any better that you're not super worried about from a markets perspective. You're more worried about a societal perspective. But I guess last question on markets, and I'll let you run. Do you have a worry that it does seem to your point? You were saying like, hey, there's still places to be long, even if you don't want to get on the train of these hyper valued assets. But are you worried that kind of all correlations are now approaching one, and so that if there is a market downturn, everything may go down with it?
Yeah, I think that's fair to say. Buffett is often quipped that in a crisis, the only thing that goes up is correlations, our correlations. I guess it is. And it's true. And so just because you own gold doesn't mean you're not going to take a spanking in a big risk off period. I think you probably will. And of course, the more extended gold is, or particularly the gold miners, they're now up 130% for the year. And basically, that's all come since the spring.
Right.
So it's you could have one heck of a shakeout even in things that are in a secular uptrend. So yes, I think, and that's why what I'm advising is to gradually, methodically sell into this rally, even with the gold miners, and just be willing to let that accumulate into cash. Earlier, there were lots of rotation opportunities. Whether it was platinum or palladium or the miners thereof, or uranium when uranium got spanked earlier this year. Not so much. I mean, that's I guess part of the heightened anxiety that I have is that a lot of these what had been overlooked assets have been on fire in many cases. So there aren't as many places to go now. If you want to go someplace where I think you're not going to get hurt falling out of the basement window is with energy, which I mean, it's just so odd to be a bull on gold as I have been for so long and a bull on energy, which I've also been for a long time, and have them in such, radically different places. But I mean, energy is now 3% of the S&P. And what is more critical to the functioning of the global economy and the flourishing of humanity than energy? Now, obviously, uranium is finally getting the positive vibes it should. I think it's still got a lot further to go. But you look at something like natural gas, or even more amazing, Adam, is Canadian natural gas. Canadian natural gas is negative, in the futures market because they don't have enough takeaway capacity. But even the longer term pricing is more like $1 per million BTUs. It's just unbelievable. It's like $1 a gallon of gas. But my basic point is that there aren't as many attractive areas as there were a few months ago. So that does make me more on edge.
Okay. All right. Well, look, let's get to the bulk of your slides here. Folks, if there is time, and I'll try to not keep interrupting Dave too much, despite how many opportunities he gives me to want to add on to what he says because he's so brilliant. But if there is time left over in the hour, we will take questions from the audience, and I already see folks starting to ask questions here in the live chat. All right, Dave, so I'm going to advance the slide here to slide 3. I don't know if you're seeing that same update with me, but the screen is on.
Yeah, the record number of fund managers say stocks are overvalued.
Mm-hmm.
I thought this was pretty hysterical. And then you flip down below, and they've doubled their allocation to stocks in the last month. And not that it's particularly out of bounds with where it normally is, but still doubling in a month. It's a little bit on the comical side. So we don't need to spend too much time on that one. Then we go to Luke Groman.
Okay. Because sorry to interrupt. I promised I wouldn't. I'll shut up after this. But do you remember the old Monty Python skit with Mr. Creosote? The hugely obese guy who just keeps eating food at the table, and the waiter comes with a wafer thin mint, and then he eventually explodes because of the mint is the one thing. But it seems like we have a Mr. Creosote market where it's just saying I can't possibly eat another bite, and yet it still just keeps cramming a risk down its gullet.
Yeah, that's a good one. I hadn't heard that one. It's the straw that breaks the camel's back, and there's going to be a straw or a mint, a chocolate mint at some point.
At some point, but it seems like the gluttony is just continuing, and even acknowledging, hey, there's way too much risk in this market. There still seem to be buying exposure hand over fist.
Yeah, absolutely. But I think this next one from Luke is one for the Uber bulls to keep in mind, is that foreigners do own trillions. I think it's something like 17 trillion of U.S. assets between bonds and equities, and they're not too thrilled with the way things are trending, and particularly realizing that the dollar is likely in a secular or long-term bear market. And the reason that matters, I mean, if you're an international investor and the S&P is up 13% this year, you're really almost flat given the decline of the dollar.
Mm-hmm.
So it is a big deal. And then there's also just the discomfort with U.S. arbitrary policies, some good, some not so good. So there is a chance of a capital flight out of U.S. markets, which, you already talked about that with Treasuries. You don't have that foreign bid, certainly not from central banks, but really not from institutions, non-governmental institutions. It's a very different world out there. I think you had Stephanie Ponboy on here recently, and she was saying, look, the way you've invested for the last 40 years is not the way you want to be investing today. Now, there certainly are vestiges of it that are continuing to work, particularly large cap tech. But even there, I think there's signs that we're starting, maybe not hitting the wall, but approaching the wall. And I just think that's something that really all investors need to keep in mind, is that the past is not prologue at this point.
Mm-hmm.
my view. This is, I think, the chart you were talking about. If we go to number 5.
We're there.
So what's happening with treasuries versus gold among central banks, and it used to be that they had this huge amount of treasuries and very little gold. And in fact, the gold was going down. I was at Mervyn King for the Bank of England back in around 2000 that sold all of the Bank of England's gold, and he basically bottom ticked it. And now, of course, they're going the other way, and the treasury holdings are coming down. And what's really not emphasized enough by this visual, you'd have to have another chart, which I actually ran with Grant yesterday, showing what's happened to total U.S. debt outstanding. And of course, it's just a hockey stick. It's just gone straight up. So that makes this divergence between what central banks are doing, which is selling, not buying. So when the government needs as much financing as it can get, and their former big customers are now saying, had enough, that's a real problem. So it's really falling upon domestic entities to be buying this $2 trillion of issuance to fund our federal deficits, which is about what they're running. And despite Doge, they're running what looks to be a record high this fiscal year that just ended yesterday. And it's just like, I mean, to have 7% deficits during a decent economy, and when we're not at least at official war, is just shocking. And I think that's going to be the ultimate problem. And related to that, I think what's going to be the trigger and perhaps the pinprick for the equity bubble is the bond market. And we've talked about that a fair amount, but there is definite signs, particularly in the UK. You know, what you're probably aware, Adam, the interest rates on long British government bonds are higher now than they were during the Liz Truss budget fee. Is very unusual.
Yes. So, David, let me ask you this. Nobody knows with any huge certainty whether there's a recession ahead or not next year. But assume for a moment, Dave, that there is, and let's just call it a garden variety recession. You know, we don't have to go into another great recession. But how high, even if we have a garden variety recession, how high do you think the deficit could go? I think
it could double, and that's such a huge point. And this is why I struggle with being attracted to long bonds, because as you know, for most of my career, I was a bond bull, really up until the summer of 2020, when the 10-year Treasury got down around 0.5%. And there have been a few times over the prior 4 years where the economy is overheating and I got bearish on bonds temporarily. But my big pivot was in the summer of 20. And that's, of course, when we were doing all the MMT stuff, modern monetary theory, money printing, money, direct stimulus to taxpayers. And it just struck me as a completely inflationary setup, which it turned out to be. Mm-hmm. But usually where I would really get bullish was when the yield curve would invert, bullish on long bonds, and which is odd. I mean, when you had short-term rates higher than long-term rates, I remember people saying, well, why would you want to buy a longer-term bond at a lower yield than a short-term bond? And the point is, well, you want to lock in that yield longer term when you get an inverted yield curve, which has been a consistent predictor of a recession. So you go into recession after the monetary policy gets too tight, as people say that expansionists don't die of old age, they get murdered, the Fed's off in the perp. But this time, I think the sequence is going to be different. I think you're going to get this knee-jerk rally to weaker economic data. And then as you start looking at these deficits exploding as revenues decline and support payments increase, that's when I think you get the next up leg in bond yields, which would be very atypical. In fact, I don't think it's ever happened before in the United States, but it has happened a lot in emerging markets. And this is kind of falling under the thesis that Luke Groman has been the number one proponent of, is that we are in a period where some of these developed countries are now taking on emerging market characteristics. Mm-hmm. And we're already seeing that, Adam, as you're aware. I mean, the Fed has cut now, 100 basis points from a little over a year ago, and yet long-term yields are higher. Yeah. That's telling us something's not right.
Yeah, it's interesting. The 10-year really hasn't budged since the Fed cut.
It's actually gone up just a little bit in yield. I mean, it's bouncing around. You can see my point, or my belief is that as we get weak economic data, you get a rally in the bond market, So yields come down, prices go up at the longer end, but they don't last. They're fleeting.
Yep.
Now, maybe if you get really, really bad economic data, which is a possibility, you're going to get a more durable rally. But I still think at some point that rally is going to reverse and swing back the other way kind of violently.
Mm-hmm. Okay. Thank you for letting me take you on that side journey. But yeah, we're going to get back to the slides.
So this is basically just reiterating what you said earlier, that we both agree with, and Grant Williams totally agrees with, that U.S. Treasuries no longer are the place where central banks, global central banks, want to put their money. So it's clearly gold. So this is, I think, a very important point that Luke is making, and I'm obviously a huge fan of Luke Roman's work, that we have to have a massive revaluation of the dollar downward for us to be competitive with China and other Asian countries primarily. And that we've seen the dollar starting to crack, based on my whole approach, which you're aware of. The 3-year resistance and 3-year support are critical. So the dollar is taking out 3-year support. So that to me tells me we're in a major bear market for the dollar, and yet it's still very overvalued. So it's almost like shorting a stock that's breaking, 3-year support, but it's still extremely overvalued. In my experience, those are the best shorts for whatever it's worth. And that's just what I was saying here, that if you look on a purchasing power parity basis, it's still really pricey. The one where it's so unbelievably out of bounds is with the yen. And that's why I have such a yen for the yen, to use a very bad pun. And frankly, I've got the Trump admin on my side. They want to get it down, the dollar down a lot, particularly versus the yen. And if you look back to what happened in the 1980s, when the Plaza Accord happened, the dollar was absolutely annihilated against the yen. So if we go to the next slide 9, we'll see this. So this is back in the kind of the mid-80 period, is the mid-80s, and how, so that's indicating the dollar is crashing versus the yen. Then we can see on the far right how the dollar has been in this really powerful bull market versus the yen since, well, basically for the last 12 years. But it does look like it's topping out on that chart. And I think if you're looking for a place to go to make money and also be in one of the few areas that probably would go up in a intense risk-off period, I think that's the yen. That's been its history, certainly lately. And if we look at this is another reason why I think it's hard to believe that the dollar is going to continue to be the powerhouse versus other currencies. And again, this is not to say it's going to lose its reserve currency status. I don't think it will anytime soon, maybe eventually. But we are the world's largest debtor country now. And we continue to run our twin deficits. So roughly $1 trillion of trade deficits, $2 trillion of fiscal deficits. So again, I just say buy the yen, and you can do it very easily. If you're saying, well, I don't know how to do that, I don't want to buy futures, but you can buy the FXY, which is the yen ETF. And it's been kind of stuck here, recently in the 150-ish, maybe 140s to 150s. But at some point, I think that's going to have a major rise in value. But obviously, time will tell. I don't know whether you have, I don't really hear that much among your guests, that I really don't hear anybody else saying buy the yen, but maybe that's a good thing. Maybe it's that contrarian.
Yeah, I have not heard that, certainly of late. I am, just last night was going back and forth with your former and again to be soon colleague, Louis Vincent Gave. So I imagine when he comes on, if things haven't changed, he may be echoing the same sentiment.
He definitely agrees. He's bearish on the dollar, but I know he thinks the yen is just stupid cheap. Yeah, he's my pal for sure. Okay, so let's talk. Can we talk stablecoins in the Eurodollar market? We touched on this last time, and since then, I think there's become even more evidence. This is slide 11, that stablecoins are becoming a very critical part of the government's funding strategy. And actually, that was a major topic that Grant and I talked about yesterday. And he agrees. He thinks that it's a very clever move. He thinks it's going to have its own negative consequences. But he really didn't have much opinion. And I know you said you were going to check on this. And I think probably Jeff Snyder is the guy to ask, what does he think about stablecoins potentially sucking trillions of dollars back to America from Europe? And it's something like $15 trillion of so-called Eurodollars. And as I understand it, and Grant basically confirmed this, where the genesis of that big, massive Eurodollar pool of capital started in the 1970s during the oil crisis. And that was, you remember, the petrodollars. So as these dollars were building up, particularly in the Gulf countries, from their tremendous windfall of oil prices, I don't know, going up by a factor of 10 back then, they put that money into treasuries, but they did it in the Eurodollar market. And so that Eurodollar market is now very significant. And I guess there is, Bessent's made comments, Treasury Secretary Scott Bessent, that he doesn't like the fact that it's kind of an implicit guarantee of the U.S. government that there wouldn't be any kind of a crisis in the Eurodollar market. They don't like that. And plus it serves their purpose. I mean, if they're looking for a way to finance these massive deficits, and they've got to be, I mean, it's clear that they're lifting up every rock to try to come up with the money. So this would be a way to do it in a bigly way, to use one of President Trump's favorite terms. So, look at Tether. Tether is, as I think a lot of your folks know, is the number one issuer of stablecoins. They're now trying to get a $500 billion valuation, because right now they're a money machine because they don't pay any interest on stablecoins. So they're holding, let's say, I think they're 150 million now of treasuries. They get, it's more than that. I'm sorry, I think it's 150 billion of treasuries. So they're getting about a 4% yield on that. So what is that? $6 billion of income with very little expense. He's got a handful of employees. So they're absolutely crushing it right now, which is why they're saying that they can get a $500 billion valuation. But they still haven't provided an audit. I went to Google Gemini, to verify that that's still the case. And they do these attestations, but they've never done an actual audit.
So can I interrupt you?
But
so
go right ahead.
Why is it so hard to do an audit? I mean, wouldn't it just be like showing them a brokerage statement? Hey, here's 150 billion of treasuries we own. I mean, how hard would that be?
Yeah, exactly. Well, I think it's not as simple, because I think there's some history involved here where, for so many years they weren't earning anything on the treasury. So it was not that positive spread. So they were doing a number of aggressive things, I believe, but nobody knows because they wouldn't come up with the information. But I mean, they weren't getting any yield, so they had to either buy longer term bonds, or they had to buy, equities or something to get a higher return, during that basically zero interest rate period. But now they've kind of fallen ass backwards into this just tremendous windfall. And I believe, as I talked about before, that Bessent eventually wants to issue government stable coins and just disintermediate the Tethers of the world. As I think Circle's the second largest holder. Why shouldn't they? I mean, what purpose really does Tether serve? It just creates, frankly, an added level of complexity and risk, and especially when they won't provide an audit. So their business model right now is just crushing it, but eventually I think they're going to get crushed. But that's just my view.
Okay, and let me ask a plumbing question here, and forgive me if this sounds naive, but I'm guessing if I'm not fully understanding it, maybe some of the viewers aren't either. So if I heard you correctly, you said that you think stable coins will basically kind of hoover treasuries out of the Eurodollar market, basically bring them out of the Eurodollar market into the US, correct? You're nodding? Do I have that right?
That's what I believe they want to do.
Okay.
Whether they can succeed is another story.
Yeah. So the government is excited for stable coins because it's looking for additional buyers of treasuries, because we want to keep yields down. So the stable coins then aren't necessarily buying new issuance of treasuries, right? If they're buying a good chunk of the 15 trillion that's in the Eurodollar market, those are existing treasuries. So is the theory Tether is buying existing treasuries from the Eurodollar market, therefore freeing up capacity for the Eurodollar market to buy new treasuries as the government rolls over its debt? I'm just trying to think, how does this help as the government?
I don't think so at this point. I mean, again, I think that's the goal. I don't think that's happening at this point. I think the goal is to get money to move, capital to move from Europe to the US in the form of stable coins, whoever the issuer is, and that money coming over, which probably is in treasuries, gets recycled into treasuries that are now within our borders. So it's
so new issuance. So that capital comes into.
I guess the advantage. But here's the key. Yeah, but the key advantage. First of all, they're not buying. Tether doesn't buy long-term treasuries, or at least they shouldn't. And I don't think they don't need to when you're getting 4% on T-bills or close to it. So that's really what stablecoins are doing right now, is just simply buying short-term T-bills. And the question is, will that money get pulled over from Euro? I think they're going to probably have to do some kind of a policy change to basically say, look, if you're over there with, you're not getting any kind of a U.S. guarantee, government guarantee. Now, of course, they can put the money in Treasuries, and I guess, kind of accomplish the same thing. But the advantage to the government by going into the stable coins is those stable coins don't yield anything. Whereas if somebody's got money in a Eurodollar treasury, they're getting that 4% yield. So and that's why I think they have to kind of put the fear of God, and I'm not sure exactly how they're going to do it, into that Eurodollar market. That's why I really would like to hear the opinion of a real expert, because I'm not. The Eurodollar market has always been a big mystery to me, but it does seem like there is a real moment of reckoning coming up here for it. And I think Jeff Snyder would say that if you destabilize the Eurodollar market, you're going to have serious reverberations around the world. But don't ask me to explain it.
Yeah. And let me ask you this, David, and maybe it's too early to tell. Is this striking you like a stroke of genius? Oh my goodness, these stable coins are going to help the administration put the camel through the eye of the needle, and it's going to be a really brilliant way to reduce government borrowing costs at a time where borrowing costs have been rising? Or does it feel more like a Hail Mary? Like, hey, we're kind of drowning here. There's a branch. I'm going to grab it. Don't know what's going to happen, but I got nothing better to do.
Yeah, maybe it's below. Maybe a bit of both. Maybe it's the Doug Flutie moment, his famous Hail Mary pass from back in the early 80s. And I think it's both daring, risky, and brilliant, or all three of those. But to really make it work for the government, that's where I think they have to disintermediate. And they're really just doing this as an interim step. But another part of it is that, when all that money, assuming it does go into stablecoins, what happens to it next? And frankly, if you look historically, the multiplier toward Bitcoin from stablecoins is very high. And I think Luke Roman has assumed, even if you bring it down to 5 to 6 times, so in other words, if $1 trillion goes into stablecoins, into Tether, 5 trillion goes into Bitcoin, or the other maybe some into Ethereum, but Bitcoin's the 800-pound gorilla. And so that's also, I think, part of this, and perhaps why the U.S. is building. They've been kind of vocal about doing some kind of a Bitcoin reserve, and perhaps that's been going on a stealth basis. None of us know that. That's just kind of speculation. So, in other words, it could be that the government's trying to get gold up a lot, as part of this whole revaluation, using that to then either collateralize or to retire treasuries, and doing the same thing with Bitcoin. So it could be a pretty powerful 1-2 punch. But to basically answer your question, I think it's a very clever move. It's obviously born out of desperation because of the terrible fiscal condition we're in. But the U.S. has got tremendous advantages, and this is just one of them. I will say, it continues to baffle me why investors in Bitcoin and crypto feel like they have to go through Tether as opposed to just doing it through Schwab. I don't really get that, but they do. Now, if somehow that goes away, then maybe this gambit fails.
Okay. I saw a quote the other day from the head of the SEC saying crypto is his number one priority right now. Is that because of the stablecoin opportunity, do you think, or is that because of other crypto potential advantages?
Well, I would say it's probably in no small part due to administrative pressure, because this administration is obviously very pro-crypto. But I think there's also the element where even the SEC, which has become, pretty toothless, and no dentures in sight, but even in their case, they're starting to rail against some of these, really egregious situations. This, what was this company, the Chinese company that it had, I think I've got that coming up here, where it had a market cap of 235 million a few weeks ago, then it hit 15 billion. And of course, people were, charging into it, and now
was that because of its
crash? And it's actually been suspended. Pardon me? Yes. And so it's another one of these companies that said we're going to be a Bitcoin treasury company. Yeah. They have, I think, 20 employees, 3 million of revenue. It's just, I mean, this, there is an old saying that in these kinds of bubble environments, you get the bezels, these embezzlement events, and they start proliferating. And you get enough of them, and people finally say, well, I don't know if I really trust these markets anymore.
Mm-hmm.
And these moonshots that we're, so accustomed to, instead of going up, they go down. And that's, to me, where I think you're starting to see that. I mean, I'll look at, I've got a comment on Doge coming up, but Doge which is Musk's favorite altcoin, to put it politely, has been cut in half this year. In the midst of this, frenetic crypto market, that's quite a divergence.
Right. All right. Well, look, I know we still have a bunch of slides to get through, and we're beginning to run out of time.
But a few more.
I want to ask my question again, which is, and you may not know the answer, Dave, but you probably don't. But I'm just asking you to guess here. How much of the administration's hunger for accelerating crypto at large is for all the other potential things that could be done with it versus, hey, we need to get this stablecoin thing to happen because we need it to stop it. We need its help in getting borrowing costs down.
Well, a cynic could say, sure, there's another key objective, which is to enrich the Trump family, but that's a little cynical.
Yeah.
But I mean, it's a multifactorial situation. There's a number of reasons, but I think ultimately that financing the government has become job one. Everything else is subordinate to that.
Okay, that's what I was figuring, but I just wanted to make sure I wasn't missing something
become
major.
Such a dire problem.
Yeah. Okay. By the way, real quick, Kieran here.
You ask somebody that knows more about crypto than I do, which is very little. The whole area still strikes me as.
Well, thanks for giving me the opportunity to mention this then. So, folks, we're going to have Lynn Alden, one of the top experts on Bitcoin, presenting at our upcoming conference on October 18th, and she is just going to be talking about Bitcoin and crypto. So I will definitely ask that question to her there then. Kieran O'Connor here asks, hey, I'm late to this thing. Oh, sorry, not any good. Sorry, that's the wrong one. It was Jack B. I meant to bring this up. Is this live? Yes, this is live, Jack, while we're recording it live here with Dave in the live stream. So hopefully you'll have a time to at least squeeze in a couple of questions here at the end. Kieran, I hope it's been good so far. All right, so Dave, let's move on to your next slides here.
Okay, 13 was really just, we already talked about it, so we can kind of skip over this whole thing to speed things up. But one thing that I did email you on here a month or so ago was one of your guests that was talking about how, how great it is that you can now buy Bitcoin on 80% margin, and it can be done on a fractionalized basis. So there's entities like Coinbase, which will make those loans, and you don't have to buy, you could buy a tenth of a coin, whatever. Right. And it's got this it's like any other margin situation. If the price starts to fall, they automatically sell whatever portion they need to sell to bring you back in compliance with the margin requirement. To me, that just creates the potential for a very intense cascade effect on the downside. Yeah. And I get the bull story on Bitcoin, but I think it's still very much of a risk-off asset. And until we go through another cathartic risk-off period to see how it holds up, I think it's not going to go down 70 or 80%, but I think it'll go down 50% this next time.
All right. Sorry, you mean Bitcoin is a risk-on asset, correct?
It's a risk-on asset, but what I think I was trying to say, in the next risk-off period phase, it probably is going to get hammered, especially with all this leverage that's involved. But yeah, thanks for correcting that.
Yeah.
Okay, we can go to 15 here. This is interesting because let's be fair. This is the NASDAQ crypto index, and this is despite Dogecoin getting cut in half. This index is still very much in an upturn, probably driven heavily by Bitcoin and Ethereum. I imagine they're the most heavily weighted in that index. So now, anything else you want to talk about crypto with a complete non-expert, which would be me?
No. Let's move on because there's
this is an area that's more my wheelhouse. So we've touched on this a little bit, but the idea of the inflation, what's going to happen to inflation, and as I think you pointed out, you get more disagreement on this than anything else among your guests, right?
That's very true. Still about 50-50.
And then, probably the economy is right up there in terms of, it's just, there's so many cross currents, there's so much conflicting data, so you can kind of spin whatever narrative you want to spin. But it's still, the fact of the matter, it's still about 3%, right? And that's using the official statistics, which I really believe are too flattering. I think it's running hotter than that. But I do see convincing arguments that with rents now falling, that this owner's equivalent rent, which has been pushing the CPI up on a belated basis, there's the lag factor in there. Your classic lag has really been at work with that, that it's now starting to go down. And that's going to be a cooling force on inflation. But of course, there's a lot of other ones going the other way.
Yeah.
You know,
And
like
let me just note
costs.
too, Dave, on the day we're talking, GDP now, I just checked it, is at projecting a Q3 GDP growth of 3.9%. So that's hotter than we've seen of late, and even hotter than the, I think, 3.8 that they adjusted Q2 up to. But at the same time, we just got the ADP numbers today, and they contracted, right? So there are a lot of these cross currents right now. It's an interesting time.
Exactly. That's my point, is that it's so confusing, and you can just glom onto whatever data point backs up your thesis. In my case, my thesis is I don't know. I continue to be perplexed, but we're going to see some things that I think are questioning the robust official government data. And this is
great.
This is really related to. Go ahead.
Sorry, I didn't know if you can see it, but I just put up on the screen a comment here from Johnny. It said, "We're in a risk-off environment right now." Off being a combination of on and off.
I like it.
Yeah,
that fits the. So we go to slide 18. This gets to where we're really getting divergence in these various inflation components, and it's. I think recently the official CPI was indicating very little medical care inflation, even deflation, and it's like, really, how does that jive with the real world? Because you probably saw that that news article that came out a couple of weeks ago that companies are facing 9 to 10% increases in their cost of medical care, insurance for their employees. So but there's certain parts where you can say, yeah, they're actually, it's very controlled. And so it depends on, I guess, kind of your mix of expenditures, how much you agree with the government statistics. But this is where we get into the economy. And so this is from Danielle DiMartino Booth, and she's been, as you know, very much in the recession already camp, not just coming, but already. But she's even noting that there is this growth pickup that your latest GDP now would only reinforce. So it is very, very confusing. There's no question about it. But, as you look at other things like retail sales, so this is store sales, which have been, quite sluggish, leisure and hospitality. I mean, we know that Las Vegas, which is typically a very good leading barometer of the economy, is quite soft, like down 8%. The most recent I saw year over year. But there's another one here that, well, this is actually from the Journal just this week. And I don't know, do you ever have people talk about GO versus GDP, gross output? Because I've seen this a lot from, well, not so much recently, from David Rosenberg. The gross output is like twice the size of GDP because it includes the entire supply chain. Mm-hmm. And that's showing a much more sluggish, much less robust picture right now. And so that's why this article from the Journal said that there is a warning below, these robust GDP numbers. But then this is right up your alley here, where we're starting to see these delinquencies go up. And for me, when I look at a chart like this, it's just like with stocks, when they're breaking above multi-year resistance, that's telling us something big is happening. And most of credit cards and autos for sure are. The mortgage and the home equity stuff is better behaved. This doesn't show subprime, if subprime is even much of a factor anymore. I don't know that it is, but I think what's happening with credit cards and auto loans is alarming enough. And how about this one? I don't know if you've even seen this. This, I think, was from...
the Google searches?
Yeah, this is pretty amazing. To me, it's like, okay, if this stuff is going on, which it apparently is, how does that square with a robust economy? Something isn't adding up.
Yeah.
And I think we've all lost faith in this.
Yeah, so something I just want to interject here. So right after we're done recording today, David, I'm going to be interviewing Anna Wong from Bloomberg Economics. Mm-hmm. And one of the questions I want to ask her, because she's pointing to this rise in growth that you've mentioned, and she says it's largely due to ramp up in business investment in software and technology. And so I want to ask her, so is this a tale of two economies? right? Is it, a slice of the economy doing so well that it is bringing up the average for everything, even though the majority of the economy might actually be slowing down, right? And this goes back to the K-shaped economy, right? Maybe even the I-shaped economy, where can't say for sure which one we're in, but these are things that you would expect to see. As long as the top end of the K or the dot and the I are doing well enough, they can keep the averages looking pretty rosy, whereas the median is just falling further and further behind.
Exactly. I saw a chart here, I should have probably included it, which showed and this I think is an estimate, not precise, that GDP and then X AI spending, AI related like data center spending, and negative when you make that adjustment. And I think
Crazy.
there is truth to that, but there's other parts of it too, like defense.
Well, exactly. Yeah.
But I think most of the time to struggle.
Well, it certainly seems so, and obviously, charts like these here with the internet searches, really show that as of quite recently, something has changed, where people are getting to a point of desperation, right? Sell my house fast, bankruptcy lawyer, sell my Rolex watch, whatever. These things are just shooting the moon. So, I don't know. I guess time will tell.
Always does. But I do think that these types of anecdotal things, especially when you weave together a number of anecdotes, are probably more accurate than these government statistics, which, as we know, tend to be erroneous, especially when they're initially released. And you and I were all over that about the jobs market.
Right. Well, and to your point as well,
in our
to your point from earlier,
jobs numbers.
Yeah, and to your points earlier, from your concern is maybe more from society's sake, right? This is you get to a point where people hit their level of intolerance of saying, look, you're telling me it's a bright sunny day outside, but I'm looking out the window. It's rain, it's lightning. I'm getting rained on when I go out there. And at some point, they really there's a breakage of faith. And one of the things that could be interesting here is, the parts of the economy that are getting really fed right now, right? The data center build out, all that type of stuff, right? We're already beginning to see spillover from that into the cost of electricity, the retail cost of electricity, right? These data centers are competing for electrons with, all of the lights on all of our homes. And people are beginning to say like, oh my God, my power bill is going up relentlessly here. And there may be a societal point of pushback where they say, look, I don't care how much AI is going to help the future of this country if I can't freaking, afford to keep my refrigerator working.
Well, especially if AI is coming for their jobs.
Yeah, exactly. That too. Right. So, okay. Sorry for the diatribe there.
No, that's okay. But I'm just on to one of your next favorite topics, credit spreads. And that's a big one for me too. Credit spreads used to be fantastically important, maybe the most important thing in terms of first the financial markets and the economy. So just as an explanation, it's the difference between what corporate bonds yield and treasuries yield. And it's really narrow right now. And it's this Wall Street Journal article pointing out that there are even people on Wall Street, as much as they love to see this scenario, that are getting worried that it's gone too far. And I think this is another tale of two situations, tale of two bond markets. So you've got the high grade bond market, where I think there's a different factor at work. I think it's more of the erosion of the credit quality of the U.S. and other Western government bond markets. And so in France right now, there is a corporate credit, not sure it's Estée Lauder, one of the big French multinationals, that where the yield on their bonds is lower than the yield on the French government bond. I think that is what's going to happen in the United States. I think Microsoft's debt will trade cheaper than the lower yield than the government. So the spread will actually be negative, which is never, well, I guess there was a time, from what Jeff Gunlock said, in the early 80s where IBM debt yielded briefly less than the US Treasuries, but it's a very, very rare occurrence. But then on the other part of the bond market, the crummy part, where you got a lot of credit risk, where you're getting defaults, and maybe you've seen this is now private credit, but so private credit and junk tends to overlap a lot, and delinquencies are now up to 8%, or defaults are up to 8% in the private credit world. I think people like Stephanie would say there's really a ticking time bomb in that part of the credit market. So I think it's a combination of this shift that's going on with the high grade part of the bond market, combined with a lot of complacency and euphoria and excessive risk taking. I don't know whether you want to disagree with me.
We've seen of late a few bodies float to the surface, David, right?
First Brands and Tricolor.
Yeah. So
yeah, those are, I think, those are really correct. I can't remember whether I get those coming up, but those are really, I'm glad you brought that up, because you remember the summer of 2007 when a couple of obscure Bear Stearns hedge funds that were heavily into subprime mortgages blew up, and a lot of people, dismissed it at the time as aberrations, but those were actually canaries coming off the perch in the coal mines, and maybe these are too.
Right. I was going to ask how notable are you paying attention to those failures? Oh, sorry. I'll ask it again. How notable are those?
Well, I'm definitely paying attention. I think it's premature to say that they're. I think they're notable. Are they conclusive, definitive? No, but I think they're a clear warning sign that something's wrong. I think there's just a lot of you've talked about this for years, Adam, and now it's really coming to the point of reckoning where all this this debt maturity wall that was postponed by the refinancings that happened during COVID, and now that debt is maturing, and so I think you're going to see a lot of these firms that the tide goes out, you find out they've been swimming naked. Yeah. And I think what was shocking about these is how quickly they imploded.
Well, that tends to, it's the old Hemingway, right? Everything's fine until it isn't, right? And we'll see. I hesitate to mention the lag effect again because I talked about it for so long and it has taken so long to manifest. But I still believe, as you just said there, Dave, that it is manifesting. And again, as it does, it won't be a train that you see arriving with lots of advance warning. You'll see a company that looked just fine, and then you wake up and read the newspaper the next morning and it suddenly is announcing its insolvency. But anyways, David, there might be, maybe it's been corrected, but I think there was a little bit of a lag in my audio to you. But anyways, I'll let you keep driving from here.
There was, but you're sounding good right now. So let's go to slide 26. And of course, it's the stock market, and it is one prodigious party, no doubt about it. And we talked about AI and what a big factor. But here's what I think is potentially being overlooked, and that is China's kind of forced encroachment into AI. And the reason I say forced is that we keep denying them the critical technology that they need to be, a leading player in AI. So they're creating their own technology to do so. And you may remember, I'm sure you do, that back in January, DeepSeek, which is the Chinese AI, came out, which was much less expensive, and that really, disrupted the AI stocks in America for a while. Then of course, we rallied on, partied on. But if we look at what China does when it goes into an industry, it destroys profitability.
It destroys profit margins. Yeah.
Yeah. So you got to, if I'm a bull on NVIDIA, I've got to be concerned that China's coming, one way or the other. Supposedly DeepSeek has got an upgrade coming in December that is supposed to be even better. But I'm seeing more and more evidence, even from AI believers, that this thing has really, truly become a bubble, and that the amount of money being spent is going to generate a very poor return on investor capital. I don't think you would disagree with that.
I don't. It sort of begs the question, at what point does the market get the memo? And are we in just a period of willful delusion where nobody really wants to admit it, because once it's admitted, then there's a cascade that starts and nobody wants the party to end yet?
Right. And I think what will be the tell probably will be when some good news, the kind of thing that causes, like you were the one to point out to me, Oracle, because you called me the day before I had even seen the news. Yep. That Oracle made that announcement, the stock went up 50%, which for a mega cap stock is just staggering. I think it added $300 or $400 billion of valuation in one day. If we get to a point where something really positive is announced, and whatever the stock or stocks are go down, I think, or don't go up, I think that'll be an indication that perhaps we fully priced in all the best case scenarios.
Okay.
All right. So let's go to 28. This is actually, I think, relevant. Are you with me?
I am. Go ahead.
Okay. So this is just looking at what China's done to robotics, just as kind of a hard data point. And they're really dominant. Of course, they've dominated with the EVs, and it's just out of nowhere. They're now the largest exporter of EVs in the world, electric vehicles, most of which are hybrid, by the way. And I think that's one thing that many investors are missing is it's not that EVs are dead. It's that traditional EVs are not where the growth is. They're hybrid EVs, and that's what the big Chinese automaker BYD is really used to pry market share around the world, except in the U.S. because of the tariffs. But of course, they did it to solar. They've got self-driving autos that are, they're basically giving away the self-driving technology. You can get a BYD hybrid with self-driving technology for something like $13,000 US. So, for Tesla, which, nobody really talks about their great EV business. They don't even have a hybrid, but it's their, robotics and their self-driving. That's what's really got justifying the valuation. But it's a PE of 275 with falling earnings. I've never seen anything like it. There's just so much hope that they're going to be able to withstand this ferocious competition from China in robotics and self-driving. I think that's a very dangerous game. But talk about a stock with momentum. It just keeps going up and up and up and up. But anyway, I do think there is severe turbulence coming for AI stocks at some point. That's just the way things are. It doesn't mean AI is going to be with us for years and years and years, and it's maybe the second coming of the internet. But of course, those internet stocks got clobbered 25 years ago after that bubble burst. But speaking of bubbles, one thing that's I think the purest way to look at valuations is to look at price to sales, price to revenue, rather than price to earnings, because the earnings can be manipulated, and they're also subject to the economy cycles. But this goes back to 2000. So back then we saw the market trade at 2.9 times sales. And back then, there was don't worry about that because this whole internet thing is such a big deal. These traditional metrics don't apply. We hear that today. But look what happened after that. It basically got cut in half. And then if we go to now, and I'm sorry we got this lower pane. It's kind of distracting. We try to get rid of it, but we would lose the years if we did. So basically, we're at 3.3 almost on sales, so versus 2.9. So we are more expensive on a price to sales basis than we were during the biggest equity bubble in American history. So there better be just a cascade of good news rather than horribles, as we'll talk about, or I think it's parade. We've got that coming up here from Danielle Park. So that's a good lead into because part of this whole approach that we use is to review your recent podcast. I'll try to do this really quickly. You had Sven Henrik on, and he said something that I had not heard, and it really caused me to go on a search looking for the GAAP PE. So if your listeners, viewers don't know, this includes the bad stuff that companies love to exclude, like stock-based compensation, and it's at 30. Now, it did get to back during the meme stock mania, which was a very frothy market, but also had a big earnings collapse. So the E went down in 2020 to early 2021. But basically, this is a really, really unusual. We're basically, again, right back to where we were in the late 90s, early 2000s. That other spike on the left side was a function of the recession, which actually was a pretty severe profits recession back in 01, early 02. So I do think he's on the right track. I think this is a good metric to look at. It's very confirmational of 33.
So David,
and Mark Newton, I actually found his presentation.
I'm going to interrupt you here, David, only because we're getting into actually the part now, which we're going to have to record on a different platform. And so folks watching.
Oh, yeah. So we should stop. Okay.
We should stop. I will take a question or two from the audience before we wrap up here, so folks don't hop off just yet. But again, real quick, David just gave you a little bit of a preview of what to expect, guys, which is we go through a number of the recent interviews that have been done on thoughtful money, and then David and I will talk about sort of some of the key takeaways that we took from it. And Dave just did one there from the recent Sven Henrik one. So a couple quick things as we start to wrap this up. And like I said, I'll pull a couple questions here from the audience before we hop off. So David, real quick, I just want to give you a chance to address the question of if AI is all of a sudden the market realizes, wait a minute, there might be a lot less profit here than we thought. And as a result, valuations are potentially severely overvalued.
Now you're back. Okay, I lost you.
Okay. So let me repeat that then. So if the AI bubble, if Wall Street finally wakes up and says, "Oh my goodness, it may bring in a lot less profits than we thought," and that makes today's valuations really extreme, or as Chris Irons recently said, makes them pornographically overvalued. Yes, there could be a really big correction in the AI stocks, but they are such a massive percentage of the indices right now that this is not just going to be like a dot-com bust, which brings down the internet sector. This is something that would, I would imagine, do a lot more damage to the general market indices and the general market, correct?
Probably. I mean, what happened back in 2000, 2002 is that as the tech stuff was blowing up, value stocks were actually going up. Maybe that would happen again, which would avoid what he just described, but that's a big maybe. So it's that's why I think it's not a bad idea to be selling into this rally and not getting out, but just beefing up your cash reserves, because again, we've never seen this set of circumstances. So I just don't think anybody can have confidence in predicting what's going to happen.
Okay, but your strategy here is to sell into this rally. It's to be de-risking in this environment.
Yes, and I like to do it methodically and gradually, rather than say this is the day.
Got it. Okay, I'm going to ask a question here from Nathan, which is, I don't necessarily know if you think we're going into a new currency regime, but he says, what will be the new currency after the US dollar is devaluated, or devalued, I think is what he meant. Let's change the question a little bit, David. If the dollar is dramatically weakened versus the yen, as you think may likely happen from here, what will the repercussions of that be? The most notable repercussions?
Well, it could be bullish. I mean, if you look at what happened the last time the dollar was drastically devalued, is the bull market of the 80s just kept on rolling until October of 87. And then after that big crash, then it kept on rolling again. And it, there were, remember back then, it was like Japan was taking over the world and they were destroying our semiconductor industry, and there was some protection put in place for the semis. And so there was another, that kind of helped set up the tech bull market that was coming in the 1990s. So it could be, I think it's what needs to happen. We do need to have more production back in the United States. We do have a tremendous cost disadvantage. And the way to address that is through a much weaker currency. But that much weaker currency is not going to be too great for long treasuries, I don't believe. I think it's going to be very good for certain hard assets. And it's probably good for companies that benefit from the reindustrialization of America, which have already been winners. I think you may remember I pointed out XLI, the industrial ETF, and that had this big breakout. We certainly called it out in our newsletter. And so there's going to be winners. And maybe even pharmaceuticals, you might notice, it's been such a depressed area, but as these companies agree to reshore their production here, and then they're back in Trump's good graces, and some of these stocks like Pfizer are just phenomenally cheap, and there's going to be good money to be made. It's just going to be probably in different areas. And personally, I think the AI area has been overexploited.
Okay. All right. Well, thanks so much. All right, folks, we're going to start wrapping up here. A couple of quick helpful links. First off, most important one, if you don't already, you should subscribe to David's Substack, which you can go get right there at haymaker.substack.com. We've talked a lot about gold this time around. If you are late to the gold game and want to understand the different ways to buy precious metals and when they make sense, feel free to read our free guide here at thoughtfulmoney.com/gold. Obviously, if you want to talk to a professional financial advisor in trying to figure out how to navigate this market and get specific advice to your own unique situation, you are welcome to have a free consultation with one of the financial advisory firms that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To do that, just fill out the very short form at thoughtfulmoney.com. And lastly, the thoughtfulmoney.com Fall Online Conference is coming up fast. I think it's just about 3 weeks away at this time. So if you have not bought your ticket yet, run, do not walk to thoughtfulmoney.com/conference. And the reason why you want to run is because the early bird price discount, which is the lowest price we've been offering, expires at the end of this week. And I want to make sure that everybody who can get the lowest price gets the lowest price. So go there. We have a phenomenal faculty this year, best one we've ever had. And one of the reasons I'm able to say that is because one of the faculty members is David Hay himself. And he'll be there talking about income investing and opportunities outside of the U.S. But in addition to David, we're going to have Lacey Hunt, Judy Shelton, Jim Grant, Stephanie Pomboy, Grant Williams, Michael Howell, Darius Dale, Sven Henrik, Andy Scheckman, Melody Wright, Lynn Alden. I'm probably forgetting one or two others, but it is a murderer's row of phenomenal macro and market minds. Hope to see you there. Again, the URL is thoughtfulmoney.com/conference. David, I'm going to ask you when we hop off here to go check your email. I'll have sent you a link to the other recording that we'll use to schedule this part 2 here for folks, and I'll see you on there in just a second. Everybody else, Thanks so much for joining us today. Let David know in the chat here or in the comment section below if you're watching the replay, your feedback on these monthly reviews with David. I think they're amazing. I'm really enjoying them, David, and I cannot thank you enough for doing this. I believe people really appreciate them, but folks, we always want to give you more of what you want and less of what you don't. So just let us know. Dave, I'm already seeing comments here in the live chat. Folks love this. So anyways, looking forward to doing this again with you in a month from now.
Thank you so much, Adam.
All right. And everybody else,
I'll join you
thank
briefly.
you so much for watching.